Good morning, everyone. Thank you for joining us today. We're here to explore how the global credit markets are evolving, public and private, liquid and illiquid, and what that means for allocators and managers over the next 12 to 24 months. I'm joined by three leaders in the credit space: Salmaan, Jeffery, Chief Business Development Officer of DIFC; Desmond, founder, CEO, CIO of Cambridge Capital Management; Holly Kim, founding partner of Glendon Capital Management. Shall we dive straight in?
Sure.
Salmaan, perhaps we can start with you. We hear a lot about investors shifting from public markets into private credit. Is that cyclical? Is that a cyclical response to high rates and volatility, or a structural long-term reallocation of capital?
It's great to be here. Just a word of context, we are a financial center, so like a financial city, and we have the privilege of working with the world's leading financial services institutions, so our perspective is a little bit different. I'd say a few things. From our vantage point, looking at our market and our clients, we see a movement in the asset class from being something that was a bit more cyclical, a reaction to kind of volatile interest rate environment, to something a bit more structural. And there's a few things that we're seeing in our environment. One is that investors are looking for a little bit more security, a bit more of a participation in negotiating the capital structure, and sometimes our public markets aren't able to provide that kind of customization. We're also in a region where the investor base is becoming increasingly sophisticated, whether it's the sovereigns, the pension funds, the family offices. And there's been a lot of in-house hiring, development of teams that look at private credit. And much like other parts of the world, also, we have a financing gap. So whether it's because of Basel III or Basel IV, there's a gap in financial institutions, traditional ones, being able to fund growth. So as a result, our investor base is looking for a bit more resilience, diversification, returns. The traditional 60-40 kind of portfolio allocation is given way to a bit more private markets orientation. And we're seeing credit being a key part of portfolio construction. Where we come in, what's our role in all this, right? Well, we're in the middle of deep pools of capital, sovereign and private. Private means family, ultra-high net worth as well. Two is the DIFC has a pretty neat regulatory platform, English common law-based jurisdiction. And of course, there's the physical reach. We're between large young populations, there's great infrastructure, and there's access for diverse kind of credit opportunities. So we're like a hub and spoke system in the space. And global managers are now setting up shop there and deploying for local operations. So it's a really exciting time for us.
Thank you. What's changed in allocator behavior? Is this a search for yield or a rethink of how portfolios are constructed?
Just for...
For Salmaan.
Sorry.
Yeah. What's changed in allocators' behavior? Is this a search for yield or a rethink of how portfolios are constructed?
Yeah, look, I think it's evolving from kind of generic kind of yield orientation to value creation. I think that's something that we're absolutely seeing. One thing I have to say about our region is a lot of the private capital outside of sovereign space comes from families, and families have a history of being operators of business. And so we see this natural proclivity of people in that space a lot more interested in developing, they behave like owners rather than like strategic investors. And so they're comfortable with more proximal positions to underlying businesses where there's a little bit more of oversight into where the capital is going, how the business is being run. And that results in a bit more tangible outcomes, right? So the short answer to the question is much more of a transformation play than a generic yield play.
My last question for you. Dubai has become a base of many private capital platforms, not just booking centers, but active deployment hubs. What's driving managers to build credit underwriting capabilities from DIFC, and how is that changing the strategy mix?
Yeah, I think the story is about dispersion rather than kind of distress. Look, I think depending on what your view is on rates, rates may stay higher for longer. It's unclear. The credit conditions are different. But basically what we're seeing from our vantage point is a lot of interest in special situations and transitional credit, a lot of refinancing happening in our part of the world. I think there's also, given where we're at, a combination of Islamic finance, a focus on real estate. There's a lot of real asset-based kind of financing and credit orientation. And I think more strategically, Dubai and DIFC are emerging as gateways for global capital, a global expertise, global managers to come in and help allocate capital efficiently into markets that are really requiring growth. Don't forget, we are in the middle of Middle East, Africa, South Asia. So in every conceivable industry, we have 20, 30, and 40-year horizons for investment in infrastructure, healthcare, education. And when traditional financing is not working, people have to fill in that gap. And that's the gap that we're hoping to provide a platform for.
Thank you, Salmaan. So that set the macro picture and the capital flow. Let's move into what's happening in the public credit space. Desmond, your world is public, is the public markets, liquid credit, daily marks, real-time price discovery. How would you describe the current demand and supply dynamics in the public bond market, especially in the emerging markets?
Right. Thanks for the question, and it's good to have this group of high caliber people speaking on the forum. For me, I am the CEO of Gembridge. We invest in global emerging markets credits, and we are your thematic alpha seeker. We are your dynamic risk budgeter, and a fundamental investor as well. So we've been doing this for over 2-3 decades, investing in this space. So public, since 2022, it wasn't a great setup because of the surprise rate hikes. We have 500 basis points of rate hike, and that scares a lot of investors who wanted to avoid the mark-to-market risk, and a lot of them hit in the money market funds and the private markets. But this year is coming back. We actually have done event studies on the relationship between fund flows and the US Treasuries, 10 years US Treasuries. There's 60% correlation of fund flows when negative correlation. When rates are low, funds are coming into our part of the world, especially at 4% and below. So this year, finally, we saw inflows around 55 billion. That is the reversal of the last 3 years. The peak of it was maybe outflow of 80 billion in 2022. So pretty much, very, I think the outlook is pretty good given the rate cut cycle.
Okay. You've talked about specific Where are you seeing the most compelling opportunities in liquid credit today? Is it duration, spread compression, distress for control, or special sits?
Yeah, I think the good question, Margaret. At Gembridge, we see opportunities in both the longs and shorts. In fact, we invest thematically, and these themes are typically derived from 3 things. One is this equilibrium between demand and supply of certain industries or sectors. And more recently, geopolitics, a lot of changes, especially of rules of engagement. We see a lot of potential alpha opportunities in there, and obviously the politics as well. We like to exploit on policy mistakes in both the emerging market and the developed market world. Here, we see spread compression opportunities into probably the last 2 miles of the credit cycle. We think the default cycle would peak towards 2027-28. That's where the wall of maturity will come and may coincide with a US recession. So for us now, I think it's a good opportunity to go long, but I think something to think about towards the end of next year, where investors need to think about tail risk hedges.
Okay. In this environment, are discounted IG bonds and converts still giving you optionality without needing leverage? How are you taking advantage of convexity?
Yeah, that's a very good point, right? So The public market, the bond market is pretty destroyed by the 500 basis point rate hike that caused a lot of IG bonds trading in 60, 70 cents on the dollar. So in the past, 60, 70 cents is distress. But here we have a lot of opportunities there where I would think also there's liability management exercises to be conducted where exchanges could make capital gains for investors as well as the issuers.
My last question for you, how should investors think about the liquidity premium in public credit versus private credit today?
Yeah, so investing in credit is quite an actuarial science because the payoff are defined, right? You buy a 5-year bond at 6% coupon, the maximum you get out of it is 30 points, right? And then you have to NPV that. But if you're long and wrong, the company defaulted and recovers zero, you lose all the capital. So for us, we're good at spotting credit opportunities, both the longs and shorts. But the tricky part is measuring market risk premium, right? For example, 2022, it wasn't a credit event, but it was more an interest rate event that caused disruption in the market. But we have our own proprietary models. That models, whether it's single B, double B, or triple B, risk premium, and we take historical 30 years Moody's and S&P default rates and recovery rates to analyze the where are we in terms of cheapness or richness in the rating spectrum.
Thank you, Desmond, for covering the liquid end of the spectrum. Holly, I'm going to move across to you. Your world is where stress becomes dislocation. We are now seeing distress activities that's more structural than episodic. What does distress look like for 2026? Is it sector-driven, capital structure-driven, or something else?
Because of the sort of abrupt moves in interest rates all the way to zero during COVID and then way back after in a couple of years later because of inflationary pressures after coming out of COVID, we really had a bubble that actually formed in 2021 and 2022, where we had over $2 trillion of LBO, just LBOs alone, which are the more speculative part of the market, $2 trillion worth of transactions. And even if they're only half financed by debt, you can see there's $1 trillion of just that vintage standing out there. So we actually, in this particular case, we do see a lot of pressure in that concentrated vintage as well as a maturity wall that kind of coincides with that vintage, right, in the coming years. So it's not very industry specific, but it is very much those sectors and asset subsectors that really depend on a lot of leverage, not only to finance itself, but also for valuations, right? So LBO is a very typical example, and that's something we point to because it's a very obvious sort of red flag that's out there. And if you've heard about LMEs, there has been over $300 billion worth of balance sheet in LBOs, over 100 transactions that have raised $60 billion at the top of that $300 billion capital structure. And that is a function of that LBO underperforming its expectations, as well as interest rate hikes sort of depressing the price of debt, so the sponsor feels the need to do something to capture some of the value. But the issue is, when that debt was issued, $60 billion for that, $240 billion of existing debt, it was at the top of the capital structure, issued at par, or pretty close to par. That paper alone now is trading at 80 cents. So that indicates to you that the remaining $200 billion underneath, or a little over $200 billion underneath, is trading way below 80 cents on the dollar. So those are the primary sort of first in line for real regular way restructurings. And then we also have, what's another industry that needs a lot of financing and depends on interest rates for its valuation. It's the commercial real estate market, and we do have a commercial real estate bubble as well, and we have a maturity wall related to that as well. So us at Glendon, we are specialists at distressed debt investing, so we manage that transition between debt to bankruptcy or restructuring of some kind to right-size the balance sheet and the capital structure of an issuer. And when that transition is happening, often it's through, because we have creditors' rights, that transition usually goes through a legal process where we reallocate some of the debt to equity, wipe out some of the debt, and then have new debt at the company to go from maybe a 5 times EBITDA debt stack to maybe a 2 times and coming out looking more like a regular way company. But sort of our asset class is reactionary to the opportunity set, but between the maturity walls and which is $300 billion for the next couple of years, but then there's another $1 trillion right behind that. And a lot of those capital structures are stuck because they have been underperforming and they're not able to refinance. And so between those sort of primary asset bubbles as well as commercial real estate, we do see a big opportunity set coming in 2026 and 27. But sort of our asset class is a function of the maturity of the private credit markets. So a lot of allocators have been allocated. Private credit is a whole new asset class that kind of got invented in the last 5 years. And big institutional investors have been allocating to it. And initially, it was to direct lending, par lending, and those have certain return profiles to it, especially if you add some leverage. But for us, for distressed debt, we're at the higher end of the return spectrum, which is sort of mid-teens returns, 2 times multiple of money type of return hurdles. And in order to achieve that part of to fill out that part of the portfolio, you really need to have built out your private credit portfolio, and then you learn to specialize into the subspecialties.
Thank you. When things do break, how hands-on do you become? Board seat, creditor committees, lending restructuring, what determines passive versus control positions?
It's actually all price. So I can give you 2 examples. Frontier Communications is a company that's being purchased by Verizon any month now, and we were the number 2 largest holder there, and we took the company through bankruptcy, really right-sized the capital structure, turned it into almost an investment-grade company, came out with a new strategy of turning their DSL lines into fiber to the home lines, and it was a tremendous success story. In that case, we replaced management. We were part of the creditors committee. We actually recruited the management team and the board, and so we were very hands-on. But that was because for the prices where the securities were trading, it made sense to get big. And so we didn't mind being one of the bigger players to get on the creditors committee. You don't always have to do that because there are bankruptcy rules in the courts where creditors are protected anyway. And so understanding what the consequences of those laws are relative to your position is really important, because in Intelsat, for instance, that was another company that was cleaned up in bankruptcy and then sold to SES recently this past summer. And that was a fabulous return only if you weren't a part of the creditors committee, because in order to be part of the creditors committee, you had to be one of the largest holders. And the largest holders were, because the company kind of deteriorated so fast into COVID, that the largest holders' positions were sort of at the highest prices, let's say 80, 90 cents on the dollar, whereas we were able to create that position at 40 cents on the dollar. So it really is about where you can create those set of assets, what multiples you can create it at, because the cheaper you create the assets, the lower your risk of loss and higher your chances and ability to make tremendous returns for your investors.
Thank you, Holly. I'm really conscious of time because this is a really short panel, so I wanted to work on talk about market outlook. So looking ahead, next 12 to 24 months, do you expect selective opportunities or a broader distress wave? Where might the most interesting situations emerge? Shall we work across the floor? Desmond, do you want to start?
Oh, I start. Okay. I think at this phase of the cycle, there's still a lot of opportunities on the long side. Especially, Holly mentioned about LBO opportunity. I think the rate cuts actually helping the case where we'll see more LBOs, M&As. For us, credit convergence play, like you buy the weaker credit thinking that you converge to a stronger credit, there's spread compression. And we see two transition themes around it. One is in the telecom sector, whereas 5G transition requires quite a bit of capex, and in some part of the world, like the Latin Americas, the incumbents may not have enough capital, and regulators are encouraging consolidation, so they will be bought over by the stronger credits, maybe from North America or Europe. It's kind of reminded me of what happened 10, 15 years ago in Asia, the 3G transition, where Singapore and Malaysian telecoms players, increased their portfolio into Indonesia and Philippines. So this is one of the good opportunities that we are seeing. Same as along the same theme as transition, but it's actually challenges in this new energy transition. We are seeing that a lot of M&A is going through, where the oil majors will buy over smaller companies in Latin America and Africa.
Holly?
I think for us, I covered before that we are looking at those bubble-licious kind of vintages, so it's pretty diversified across the board, but obviously you have to look at some of the larger issuers of debt, and we are seeing the telecom sector, especially cable in the US, seeing a lot of fierce competition that they haven't seen before from fiber. We do see some sort of asset reallocation and, quite frankly, multiple resetting that's going to happen to right-size those balance sheets. But any leverage situation with a catalyst, so a lot of those balance sheets with 27, 28 maturities, we believe in 26 are going to have to face some day of reckoning.
Salmaan?
Lots to unpack. Maybe I'll summarize three things. I think we are, at a different stage of economic development, right? So our capital markets, particularly on the credit side, are significantly smaller and underdeveloped. But a few good things. One is places like the DIFC at least provide the regulatory and legal infrastructure. So there's recourse, right? There are consequences for failure, and as a result, financial intermediaries, creditors and lenders in the region rely on the safety and security and transparency and rule of law to function the right way. That's number one. Number two, I'd say we are just at the very, very beginning, on the private side at least, of growth, simply because it is an asset class that has not yet existed in the region, but because so many infrastructure and other segments are thirsty for capital and not being met, we're seeing the beginning of that. So we don't have, it's very interesting, we don't have those vintages yet because we haven't actually, that cycle is just starting. And then the third thing I'd say is I think what's really important for institutions like the DIFC in Dubai are to provide sensible platforms for capital to be both deployed the right way into the right segments. And that's done not by us, but by experts, by managers who know sectors and who know the asset class and the product. So as long as we are able to do that, we'll have the right people come to a region that requires significant capital up and down the stack. And we're, in the coming years, we'll start to see some of the things that my panelists have talked about.
One last question. What's one risk the market is underestimating?
Me? All right.
Okay, let's start with you.
I think the three major sell-offs, right, in 1997 was, no, 1997, yeah, it was like that, long time ago, was balance of payment crisis, but was disrupted by, shorting on the Asian currencies. And 2008 was US housing problem, but became disrupted because of all these CLO, CDO instrument that came out. 2020 was mobility crisis led by the pandemic, but the actual product that was disruptive was the risk parity strategies. But going forward, I think the next shoe to drop will be a liquidity crisis. That's because of the 3 years that a lot of money that went into privates, and with a U.S. recession, it's not a if but when it comes about. I think that's going to be the products will be quite disruptive in terms of ability to raise cash to.
How about you, Holly? Anything?
I actually think people are underestimating connected to your recession prediction. There's a big bifurcation in the U.S. economy and economies all over the world. There are the haves and the have-nots, and 10%. The top 10% of U.S. consumers control over 50% of consumer spending. So consumer spending might look healthy, the economy might look more stable than it is, but we really have a vast majority of U.S. households really struggling with the higher prices of commodities and everyday goods, but also financing costs as well. So we are starting to see some early signs of credit deterioration within the consumer market, and our economy is very much built on the consumer.
And Salmaan?
Very quickly, I'd say two things. For emerging markets, number one is for us, is when capital doesn't flow freely, bad things happen. And the second thing is very non-strategic. It's this information asymmetry. People underestimate in our region the importance of good information about companies so that sensible credit decisions can be made, and we consistently underestimate the importance of data.
Thank you, everyone. Thank you, Salmaan, Desmond, and Holly, for your exceptional insights. And thank you all for joining us. We hope you enjoy the rest of the conference.